start sharing my screen. Just bear with me, please. What's happening to my Zoom here? Okay. Okay, everyone can see the screen well, hopefully. Perfect. Just put my chat close so I can monitor the chat for you. Okay. Evan was asking if is the effect of compounding part of the quiz. Okay, annuity, if you have any reason to transform, you might, but mostly chapters 3 and 4. So if you don't see it in chapters 3 and 4, no, you're not going to have effect of compounding. So Subeka is asking if we get a review package for the midterm. You already have it, Subeka. You had it from day 1 on D2L, which was basically a sample midterm and sample final exam that you can work with, okay? All right, so that answers your question. All right. All right, guys, let's start. I'm gonna start recording just for transparency purposes. Nothing gets uploaded.
This meeting is being recorded.
All right, so welcome back. Today we're going to start chapter 5, which is all about interest rates. We started some of chapter 5 together last week when I talked about conversion between the rates, APR, EPR, and EAR. So all of that belongs to chapter 5. And we're also going to review the time value of money problems that you had from previous class. I'm going to give you the guided steps, and I'm going to help you how to work with them. After that, I expect that in the next few days that you are off, you are going to focus on them, work them out before I upload the solutions, okay? But I plan to upload the solutions so that you can have them ready for your midterm. Okay, so today's agenda, we're going to talk about interest rates. So last week we learned APR, EAR, EPR. So we learned three different rates and the conversions between them. This rate, we're also going to talk 2 more rates, like what is it when we talk about inflation rate and how we can actually include it in a rate. Do we have a name for it? Yes, it's nominal versus real. So we're going to talk about these 2 rates. Everything we learned today, the new part, is about the effect of inflation. After that, we're going to talk about determinants of interest rate. What is it that Bank of Canada has a certain rate right now, okay? This rate, the prime rate can be 0.5%, 7.75%, 1%. What is it that makes the bank make these decisions? We're going to learn a little bit about that. And then we're going to talk about yield structure introduction, which was going to come up in chapter 6 mostly, but everything that we learn here is just an introduction to the yield structure. The exact calculations of it we're going to learn in chapter 6. In order to give you a heads up again, this is our last teaching material before the midterm. That means that by the end of today's class, you have learned everything you need for completing your midterm. While you prepare for your midterm, these are some of the time value of money problems that are important, annuities problems, mortgages, and pensions. And that's why towards the end of today's class, I'm going to walk you a little bit through the examples that I have given you, guide you a little bit how they are done, but ask you to definitely take some time, focus to many, many problems under each category while you are taking your reading week, okay? So that's the idea here. Okay, so let's talk about inflation and interest rate, the first new topic of today and probably the last new topic that you're going to learn before the midterm. You have $100 today. You can either consume it immediately or invest it and receive 115.50 in 1 year. If you invest it, what is your nominal rate of return? So the question is asking for nominal rate of return. First of all, the word nominal is new to us. We haven't seen it before. What I can tell you is that every time you calculate the return based on the numbers that you see, the amounts and prices, regular amounts and prices that you see, those are all nominal. It means that they are not the real prices. The real is something that includes the impact of inflation. So basically this question is giving you two prices, $100, 115.5. Can you tell me what's $100? It's the price today. What do we call it in time value of money terminology? PV Doy, very good, excellent. Jessica, that's correct. Present value. Antonio, that's correct. Noah, very well. So what about 115.5? What's that one? Very good, future value. Everyone understood that. Amanda, Maurizio, very good. Katrina, sorry, it's too many of you. I can't read everyone, but very well done. Priscilla, that's correct. So 100 to 115.5, it's basically PV and FV. And right now, you can try that in your calculator for me. You have a present value, you have a future value, you have the N, which is 1 year, and you are going to find the interest rate for me, the rate that comes out of your calculator. What is that? Can you do that? What is the rate of return? Very good. Raymond, that's correct. Ragavi, that's correct. 15.5%. Basically, if you want to look at the formula also, it's quite simple. Also, it's very similar to the growth rate formula I taught you at the beginning of the course when I was talking, okay, Zoom price, how much is it? What was the growth rate? That's exactly what this is. For example, I can ask you, let's pick up Zoom's price yesterday and today. What's the rate of return, daily rate of return? Alternatively, we can say, okay, what was Zoom price January 1st? Let's look at it now. That would be the rate of return year to date, okay? So 15.5%, that's correct. That's your rate of return. Luis, that's your answer is correct. So Luis gives me 15.5, which is what your calculator gives you. Is that right? But what I want to remind you always is that your calculator already assumes that the rate is in percentage format. So make sure everyone understands that and is comfortable with the idea that what you plug into your calculator is always assumed to be percentage, and when it comes out, it's the same. When you receive a rate, make sure that you remember it's a percent. Okay, so that's it. So far, we didn't do anything special. We just said, okay, you can invest your money. 1 year later, your money is worth this much. And we talked about the rate of return being 15.5%. Now, we're going to bring in the topic of inflation. Assume that pizzas cost $5 each today. By that, I mean probably each slice. If you bought pizzas instead of investing the $100, how many pizzas could you buy today? So basically, we want to see the value of money for immediate consumption. So that's $100. What if I immediately consume it? How many pizzas I can buy today? How many is that? 20. Good job, Luis. Asha, that's correct. That's 100 divided by 5, 20. Now, 1 year from now, the price of pizza is going to go up. It's going to be $5.25 in 1 year. Okay? So the question is, if the price today was $5 and it's going to be $5.25 1 year from now, what is the inflation rate? What is the rate of inflation? Maurizio says 5%. Harsimaran, the same. Grant, Raymond, good job. That is correct. This is how you guys did it, right? Basically, you can also use your calculator. 525 is the future value, 5 is present value. You ask for the rate, and you find that the rate is 5%, and that's your inflation rate. That's correct, Jessica and David. So 5% is the inflation rate in this economy that we're talking about. So far, this is what we established. If I spend that $100 today, I can buy 20 pizzas. If I invest that money 1 year from now, I can have $115 and $50. okay? So I can have a little bit more money. If I wait to consume it later, I have to keep in mind that there's going to be $5.25. Pizzas are not going to be same price anymore. And that's what the next slide is about. What is the real rate of return if you invest your $100 today instead of buying pizzas immediately? Real rate of return, it means that, okay, I know that nominally, the previous slide had that. Nominally, it means looking at the general prices, you had 15.5% rate of return. Now the question is, what's the real rate of return, okay? So in 1 year, your it's good that you invest your money, you will have 115.5. However, how many pizzas can you buy with 115.5? Which means that at the new prices of $5.25, how many pizzas can you afford now? How many? 22, that's correct. So really, my real purchasing power growth is that if I consume it now, I can buy 20 pizzas. If I invest the money and buy pizzas 1 year later, I can buy 22 pizzas. So the question is, what is your real rate of return? Your real rate of return is your real purchasing power, okay? We don't care about the nominal value of money. Is it $100, $1,000? It depends on, okay, how many, let's say, cars I can buy with that money today versus 10 years later when I invested. So your real rate of return is the percentage change in your buying power, 20 to 22. Can you tell me what that rate is when something grows from 20 purchasing power to 22? That's correct, Jessica, 10%. So really, your real purchase power or real rate of return is 10%. It's not 15%. Does that make sense? So what we are trying to understand here is that all the rates that you see, and in this world when we all talk nominal. We say that, okay, there is this much rate of return, this much rate of return. But there, in reality, you have to offset some portion of it due to inflation. When you offset some portion due to inflation, what you will get is, the real rate of return. So David asks where I got the 20 from. The 20 was how many pizzas I could afford with $100 today. Immediately, my money gave me the purchasing power of 20 pizzas. If I invested and waited for a year, my purchasing power increased to 22. Now, obviously, I'm not going to ask you to do inflation problems every time by doing pizzas, okay? We cannot do that every time, count how many pizzas we can. So we like a formula that connects these three rates: inflation rate, nominal rate, and the real rate of return. That formula is called Fisher effect. Fisher effect is the relationship between real rates, small r, nominal rates, capital R, and expected inflation, which we show by H, and that would be 1 plus capital R equals 1 plus small r times 1 plus H, which is the inflation rate. So as you can see in the formula, it's not really a simple summation. You cannot say nominal equals to inflation plus real. It's a bit more than that. That's why in this example, it wasn't 10% plus 5% giving us 15%. It was more than that. It gave us 15.5%. So that's the new formula that you're learning, and in fact, the last formula that you learned for prior to midterm, okay? The material that you have prior to midterm. Remember, financial rates, the interest rates, discount rates, etc. Everything that you and I have been talking so far, they're all quoted in nominal rates. Okay, so when there's no mention of inflation, there's no mention of real, everything is in fact nominal. Okay. That's it about the inflation and interest rates. Now let's take a look at determinants of interest rates. Inflation and real versus nominal interest rates. The nominal interest rates, just going over the terminology for you, are quoted by banks and other financial institutions that indicate the rate at which money will grow if invested for a certain period of time. So basically, nominal interest rate is all the rates that we'll look at these days. Real interest rate, however, is the rate of growth of your purchasing power. after adjusting for inflation. Okay, if you have an investment right now that gives you, let's say, 5% return, keep in mind there's also inflation. So in your mind, if you account for at least 1% inflation, your real return is not 5%, it's less than 5%. The formula again is what we saw already. The growth in purchasing power can be calculated as follows. 1 plus growth in purchasing power is 1 plus real rate, or equals 1 plus nominal rate over 1 plus inflation rate, which is telling us that it's the relationship between growth of money versus growth of prices. So that's the equation from your textbook, but it's also the same equation that I showed you already. So if you just multiply these three, you're going to get the same thing. Remember? So this is your 1 plus real. This is your 1 plus nominal. This is your 1 plus inflation, right? So 1 plus small r for real, times 1 plus inflation equals 1 plus capital R for nominal. It's the same formula. What you see in your textbook, and I put it here, is that your textbook says this is telling us roughly, so this is not equal. This is saying, okay, if you're in a rush and you don't have time to do all the calculation, which is time consuming, this calculation gives you the exact real rate. It says if you're in a rush and you just want to have an estimate, the estimate is that, okay, take the nominal rate minus inflation rate, okay? So that's why the answer that we had was 15.5%, which is slightly different from 15%, okay, which was 10 plus 5. So when you're talking to investors, investment bankers, and when they tell you, okay, this process or this investment gives you this much in return, what you can do is basically you take that value minus the inflation. So if we are in the time in the economy where inflation is high, let's say 3% inflation, then you're going to deduct it and find an estimate quickly. If we are in a period where inflation is right now, it's really low, it's around 1%, so then you have another estimate in your mind. Okay. Now, there's an example in your textbook which calculates the real interest rate. These questions, the examples are not hard, okay, in this whole chapter 5. What is hard is the terminology, to understand what they're talking about, okay? So that's why I chose to go through it so that you understand, okay, what variable you use and what. For example, a bond is just a debt, right? It's a borrowing, it's a lending, so it's just called a bond. But all you have to do is to think about it like a time value of money question. In the year 2000, short-term Canadian government bond rates were about 5.8%. Rate of inflation was 3%. So based on our terminology, let's call it H. So this is my inflation. Interest rates were about 2.7%. Then 3 years later, interest rates were about 2.7%. And inflation was 3.1. What was the real interest rate in 2000 and in 2003? First, you read the question. As soon as you see the word real interest rate, you see that the rate that you were given, because it didn't identify real, now I can say that, oh, this was my nominal. See that? Because the question is asking for real. That means this is my R. And then the question is asking to find real, which is R, small r. Is that right? And this question has just repeated information. 2000, 2003. What happens? Okay. Is that good? All right. So let's do that together. This is the formula. 1 plus. Let me see if I have the solution here. So that's okay. I can write 1 plus R nominal equals 1 plus R real times inflation. In this question, the small r is unknown. the real interest rate. So why don't we simplify it and say that 1 plus R equals 1 plus capital R over 1 plus H. Let's do that. You want to give me the answer for 2000? What is the answer for year 2000? That's correct, Joy. 2.7184%. Or Jessica and Nusha, that's correct. You round up 2.72%. What's the answer for 2003? For 2003, that number is? That means you're going to take 2.7 and 3.1. Very good. What you're going to see, surprisingly, are you all surprised when you're getting the answer? Yep, you're surprisingly getting a negative real rate of return. See that? You have a real rate of return which is negative. That means the nominal return that you are promised is not enough to meet the inflation. Very good, that's correct. Jessica and Joy gave me the right answers. The bond rates tell us the nominal rate. So this is giving us the directions. Given the nominal rates and inflation for each year, we can calculate the real interest rate. And when you do that, for 2000, it's this much, and for 2003, it's negative. So these are the two answers that you got. Note that the real interest rate was negative in 2003. What does it mean? What does a negative real interest rate mean? It means that the interest rates were insufficient to keep up with inflation. The inflation was going faster. As a result, investors in government bonds were able to buy less at the end of the year than they could have purchased at the start of the year. So the purchasing of the bond didn't protect them, didn't help them towards inflation. Okay. Now, interest rates are the way for economic policymakers to keep an economy healthy. So that's why we have a wide area in finance that looks at policy, interest rate policies and such rates. Now, when it comes to investment and interest rate policy, remember that when the cost of an investment precedes the benefits, that means the cost is more than the benefits, an increase in the interest rate will decrease the investment, which is what we just saw. If the interest rate increased over time, it actually decreased the investment value. Now, the last few slides that you're going to see is just an introduction for the terminology and the idea of the interest rates and where you see them happening, but they're not going to be part of your midterm. They're going to be connected with Chapter 6, mostly. But I want you guys to give me some answers. I want you first to look up the Bank of Canada overnight rate for me. What's the Bank of Canada overnight rate? Just Google Bank of Canada overnight lending rate. That's the value that the policymakers change in order to keep our economy intact, right? We are going through what is supposed to be a second financial crisis, and what the bank is doing is they are going to fix that by keeping the rates low. That's correct. Good job, Joy, Kevin, David, Nusha, they all gave me. We are now at 0.25% or a 0.25% interest rate, which is for Canada. Right now, this is the rate that our banks, primary banks, can borrow from the central bank, okay? That's why we call it the overnight rate set by Bank of Canada. So 0.25% is really low. In the previous financial crisis in 2008, some of you might remember, some of you don't, but the lowest that our Bank of Canada dropped the rate was 0.5%. Now we're at 0.25, okay? So these are good numbers to keep in mind and understand what kind of economy we're in. So officially we're in a recession. The next few slides are going to make more meaning to you now that I explained that. The term structure of interest rates. First, we want to know this interest rate that we talked about. What is it the result of? This is the relationship between nominal interest rates on default-free, pure discount securities and time to maturity. So term structure means time versus interest rate, okay? Because term means time. It's determined by three components: the real rate of interest, which is what you saw. As we can assume that the real rate of interest is that. The rate of inflation, which is how much is the inflation right now? Do you want to look up that for me too? Like, what's the inflation in Canada right now? So we have different models that calculate inflation. They look at the cost of goods sold and such. But you can take a look and see what's the, let's say, official inflation for 2020 for Canada. And give me the answer. Do a little bit of Google search. Very good. Exactly, Joy. It should be something less than 1%. Yeah. Very good. Joy, Alyssa, Luis. So the inflation right now is at 0.61%. So almost 0.5%. Okay, which is very low. A regular inflation, if you guys want to know, is around 2%, 2.5%. But right now we're at 0.61%. So the determinant of this 0.25% set by the government, one of the determinants is that inflation. So that's the reason why that rate is low. So that's what we mean here. It's determined by three components: real rate of return, rate of inflation, and interest rate risk, which means we don't know what's going to happen over time. The rate is going to go up or go down. The term structuring can be upward sloping or downward sloping. We do exclude effects of default risk or different coupons or such, okay? So we're not getting into details of bonds, okay? We're just assuming that this is pretty much the cost of capital we're talking about. So this is a glance of an upward sloping term structure. And this is the interest rate risk premium, inflation premium, and real rates. You can see that over time, you should get higher return. That means that if you're lending your money for longer periods right now, you should get higher return. That's what happens in a healthy economy, because inflation, look at that, inflation is more or larger over time. When we have recession economy, something like this looks like that. So cash is very limited at the time of speaking. So you can see that over time, in fact, inflation in a recession economy is very low. You can see that it's going down, right? So that's some of the observations that we have for policymakers. Again, no questions here from this for your midterm. This is just for your understanding and understanding of the terminology. So with that in mind, let's make sure that you learn the terminology though, and these are the determinants of interest rates. Term structure is the relationship between investment term, means the length, okay? Here when we say term, it means the length, it means the maturity, and the interest rate. That's what this graph was about. Look at that. On the x-axis you have time, on the y-axis you have interest. Then you have yield curve, which is a plot of bond yields as a function of the bond's maturity date. Now, I know that we learned the bonds in chapter 6, the details and calculations of it. But we learned the terminology in chapter 5. So we should know what a bond is. And actually, you learned it in chapter 1. What is a bond? The amount of money that you borrow or lend. Okay? So very simple understanding, you should know. The risk-free interest rate is the interest rate at which money can be borrowed or lent without risk over a given period. And usually when we verbally talk about risk-free, nothing in this world is risk-free. The closest thing that we can think of being risk-free is the money that you lend to the government, because we know that it doesn't default, right? So that's why we say government bonds or treasury bills or T-bills, if you have heard of it. In US, those are the closest you can find to risk-free assets. Now, we talked about bond yield. This is a yield curve example, yield in finance with return. So when I say yield curve, that means I'm giving you the return on the y-axis, and in the x-axis, I'm giving you years to maturity. Means as you can see, if you are locking your money for longer period, you should expect larger interest, right? Larger return. And that's what's happening in this graph. What it's telling me is that if you purchase longer maturity bonds, your return should be higher. As you lock your money for longer period, you are entitled to larger return. It's based on coupon bond yields, unlike the term structure, which is based on pure discount bonds. So this is the last one, is telling you the difference between this graph and the previous graph, right? This graph is looking at coupon bond yields, different coupons, but this one is the pure discount. Finally, let's determine this rate that I just talked about. The Bank of Canada determines very short-term interest rate through its influence on the overnight rate. You guys all looked up the overnight rate for me already and told me that it's 0.25%. That's our overnight rate that it's the rate at which the banks can borrow cash reserves on an overnight basis from the Bank of Canada. If interest rates are expected to rise, long-term interest rates will tend to be higher than short-term rates to attract investors. This is what happens in an economy that we know the rates are going to go up. Okay? If interest rates are expected to fall, which happens in an economy, in a downturn economy, like everyone loses hopes in the immediate return. So that's why long-term rates tend to be lower than short-term. People want to think about this right now. At the time that we are in, it's a little bit of economic uncertainty going on. So any investor would like to get the return very quickly. So no one is interested in locking up their money for long-term period. That's why, for example, long-term projects are not taken on a lot these days. Like we have to look into short-term projects. Long-term rates will tend to be lower than the short-term rates to attract borrowers. So in each economy, you're targeting a certain subgroup. In an economy where interest rates are expected to rise, we want to attract investors. Okay, we want to attract investors. In an economy where interest rates are going to fall, we're going to attract borrowers because we want them to borrow from us. We lock the interest rate, and then the rates are going to go down, right? So right now, for example, the banks are more interested in giving fixed rate mortgages, right? Because they want to lock the interest rate because they know the rates are going to go down. Whereas when the rates are high, like the banks are more interested in locking, for example, variable interest rates because they know the rate is going to go up and they can make more money off of them. The opportunity cost of capital or cost of capital is the best available expected return offered in the market on an investment of comparable risk and term to the cash flow being discounted. So opportunity cost of capital is basically the R that you and I talked about all the time. The R, or rate of return, is the same as opportunity cost of capital. It's the generic one, okay? In the previous ones, when I talked about yield, this was specific to government bonds and such. When I say opportunity cost of capital, is basically the rate that the companies should borrow at, you and I can borrow at, or can basically invest that. So this is opportunity cost of capital. And that's it, guys. That finishes the terminology from chapter 5 and all the material that we had left prior to your midterm. So pretty short, I know. So what I'm going to do for the remainder of the class is I'm going to one more time go over last week's slides, go over the examples, walk you through the steps, guide you through them, and then what I do ask from you is that you are going to spend time on those questions before I post the solution, please. Please do that because otherwise you won't learn and you won't be ready for your exam. Okay. Any questions before I move on? So two things you guys checked for me. You checked the overnight rate. Good job. You also checked the inflation rate for me today. Okay. Let's go to now last week's slides. Let's quickly take a look. This is where we have more time value of money problems. Sorry about that. Just bear with me as I find my slides again. Why don't we take a 5-minute break while I figure it out, please? For some reason the slide is not showing up. Okay. Just a 5-minute break, guys. on the 5-minute break and I figured out the issue. All right, we should be good now. Now, I told you that that finishes the new material and anything that you needed to know for your midterm. With the remaining hour, what I would like to do is I would like to focus on the material from last 2 sessions, which is anything to do with chapter 4 and a little bit of chapter 5 in terms of compounding. So what I would like to do is to guide you in the questions that you have here. On this set of slides, which is the set of slides that we had for last week, the session 4, on this set of slides, you have, in fact, 5 good examples that I want you to work on. And I'm going to share the solution to them. But before I share the solution, I want you to pretty much work at them yourself, okay? So I think we're good. So a quick recap. What did we learn for time value of money? First of all, we learned how to move a single cash flow in time, okay? Present value, future value. You should be very comfortable with your calculator doing that. On your calculator, you have PV, FV, right? If it's a single cash flow, you're using one of these two. You have N or number of period, I over Y, which is your interest rate. Then we said that, okay, apart from the single cash flow, what if you have regular payments? As soon as you have regular payments every year, every month, every period, every quarter, then you're dealing with an annuity. And for an annuity, on your calculator, you have PMT. PMT is the payment to your annuity. These 5 are your best friends. You have to learn how to work at them in the calculator. The tricky part is to know the signs, PV, FV, and payment. Which of these are negative and when, okay? Generally speaking, you're gonna plug in either the payment or PV negative, okay? So generally speaking. However, most of the time, the best way is to think like a bank. Your calculator thinks like a bank. If money comes in, that's good, positive. Money goes out of your pocket is negative. So make sure that you consider that loop. If you got a mistake or if you got an error in your calculator, make sure that it's some of the reasons for that. One more thing here was that your I over Y or interest rate in your calculator is always usually assumed to be percentage format. So that's why, especially when it comes to rate conversions, 0.5%, when you have 0.5%, some of you might make a mistake and just put 5 there, but that's wrong, right? So that's basically you're not 5%, it's 0.5%. Okay. So those were some of the ideas here, and by now you should be good with your calculator. For today's quiz, I believe all the questions you can do them with your calculator. One more process here that was perpetuity. You don't have it in the slides here. That's also part of your quiz today. So perpetuity, and what you had was a regular perpetuity, present value equals C over R. That's for a regular perpetuity, the easiest formula in finance, and that's why we don't have it set up in the calculator, because you can actually calculate it yourself. Priscilla is asking where these functions are. If you are working with your Casio, yes, this is under compound interest. So in Casio, you go with, first you pick TVM functionality, TVM. So when you're in the large menu, press TVM. After TVM, you go to compound interest. You are picking from the functionalities that you have, always compound interest. And this is what for prior to midterm, the only place that you work with is your compound interest. After midterm, we're going to use other things. If you're using your Texas Instruments BA2 Plus, you know that you have already, so that's a financial calculator. So already you have the buttons for them. You don't even need to go to a certain page. With Texas Instruments, however, what I can guide you and remind you is that always clear work or clear time value of money. So I have posted a guideline for you under information folder. You can see that it's a calculator guidance sheet. You can do that. how to set up certain things in your calculator, I leave it to you. It's fairly simple. Just to scroll up and down, you know what to set for each of them. Okay, particular questions about the quiz. I can't tell you what is on or not on the quiz. There's only 4 questions, but it's randomly picked for all of you with random input variables. So just focus on your own question. The other student might have the same names and such, but it's a completely different question. So no need to say to do your own work, please. Enough. The time is only enough to do your own work. And yeah, I think that's it. Daniel says, I put the values, I get an error. Daniel, we just talked about the signs, right? If you put the present value and future value, both of them positive, there is no transaction happening. You have to put one of them negatives. If you get error, usually it's because you forgot the negative. So try that again, Daniel. Let me know if it works. Diana is asking about the beginning or ending, which is, I'm getting into Diana as a review, but basically that's annuity due, which means that the payment should happen at the beginning of period. If the question says that the payment is happening at the beginning, then you have to do that. Good job, Daniel. So you made it work. Carlo, I can't tell you. Carlo is asking, are PV and PMT always negative? No, that's not the right way to say it, and that's why I can never tell you if they are always positive or negative. Question by question, it can be different. What I can tell you is think like a bank. If you have one of them as positive, the other one should be negative. There should be a loop activity happening. Money withdrawn, money deposited, okay? You cannot just keep withdrawing, okay, now and in the future. Where is the transaction, okay? So the best way, Carlo, is to do more problems so that you get more familiar with. Maurizio is asking, what is a clear way of differentiating perpetuity and annuity? I told you guys there's the keyword that you see that you know it's perpetuity. What's that keyword? Can you give me some of the keywords that tell you that's perpetuity? Forever, infinite, forever, yes. No, per year, no. Per year is for anything. It can be annuity, it can be perpetuity. But as soon as you hear the word forever, yeah, Mohammed, thanks for capitalizing. Forever, yes. Jessica, Nusha, Amanda, that's correct. Another way to know it's a perpetuity is a process, is a donation process. What do we call that? That's also a perpetuity. So they might not say particularly forever, but they say, okay, we are creating and we had a problem, we had an example together. Sukrit, that's correct. Endowment. An endowment by default, Jessica, that's correct. An endowment by default is a perpetuity. Monica, for perpetuity, there's only one way to find, and that is PV equals C over R. If there is a shift in your perpetuity, because remember, perpetuity doesn't have an ending, so it can begin any point in time. If there's a shift, you have to work at it yourself. That's why you draw the timeline. That's why we had a good example last week that we went through the details, okay? There is no alternative formula for it. Very good job. Okay, Kevin, might be a little late to ask these questions, but C is for payment, okay? C for cash flow is for payment, if that's what you're asking. Mirelle is asking, how would you know a problem is a regular or growing annuity? So again, you just mentioned it. If a question says it's growing, that's growing. If it doesn't say it's growing, it's not growing. I think growth is a very particular, clear way. So let's keep on going. So last week, here's what I want to identify because I want you guys to work at them in the next few days before I post the solution. First example from this set of slides, I want you to work at it. This is an annuity problem. We talked about it last week. So you're going to have 2 annuities. The first 5 years, it pays 500. The second 5 years, it pays 1,000, right? Because of that, you're going to draw 2 annuities for me. Annuity 1, annuity 2, and you're going to find the present value, okay? So make sure you have this. This is the sketch that I can give you. I will post the full solution because it doesn't help if I write here. I cannot post this one. So that would be it. Nusha, I think that's the right answer. The present value is correct. Dewey, that's the right answer. 5,686. I think it's the right answer. I have that, but I will post it for you. So next one. The next question, it's similar, but this time it's the future value of an annuity. Okay, so similar to the previous problem, but this time we have a future value problem. Why is it similar? The payments are all $1,000. So what is the problem here? Why can I not deal with it like $1,000 because everything is $1,000? Well, the problem is the rate is changing. That's correct, Amanda. So the rates are changing. At first, the rate is 5%, then it's 8%. When we talk about an annuity, all the attributes should be the same throughout the time. If it's changing, then you cannot use it. So this is what you're going to find the FV of the first one, FV of the second one. Do any conversions that's required. I leave that to you, and you are going to find the future value for me because the question asks for at the end of 10 years. So this time is interested to know at the end of period. Okay, so this is where we saw growing annuity for the first time. And I said that write down this formula, keep it handy because growing annuity is not something that's part of your calculator. You have to do it yourself. Kevin is asking, does inflation affect annuity? That's a valid point in Kevin. Inflation affects everything. Inflation affects everything. But what I can tell you is that you don't see the questions that mix the two. Okay, so if I ask you an inflation question, it's just going to be an inflation question, which means that, okay, real interest, nominal interest, inflation. Give me one of the three. That's an inflation question. Everything else in this world, including annuity, perpetuity, everything is impacted by inflation. We are daily impacted by inflation because our purchasing power is decreasing. But we don't do, when we are solving the problems, we're always assuming that everything is nominal. So we did these problems together. We also had growing perpetuity. We found the formula for growing perpetuity. Again, very simple formula, but have that handy. And then we talked about annuity due. If an annuity starts immediately or begin now, in your calculator, you're just going to switch from END or end to BGN, our beginning. And we talked about this last week, so I'm not going to spend time here. Then from here onwards, the effect of compounding, I can tell you that this is chapter 5. So this is something that it won't be on your quiz today. So for today's quiz, what I want to expect you all to know is to know how to use your calculator with all those 5 input variables, PV, FV, PMT, annuity, perpetuity, everything like that, you should know, okay? With effect of compounding, we learned how to convert the rates. You have to know how to convert the rates, guys. You're going to need it for mortgages later, for your midterm. That's going to be important. We did different problems together. All of this we did in class. We finished a complete mortgage problem together and did some follow-up questions. What's the outstanding balance? We did all of this together, the interest charges and such. Then we get to where I wanted to stop. We had the 3 more examples. So this is question 3. So when I post the solutions, I'm going to post the solutions. Question 1, question 2, question 3, question 4, question 5. Question 3 is let me walk you through it again, like the previous 2 questions, so that you're familiar. When you were born, your dear old Aunt Karen promised to deposit $100 into an investment account. At the end of every month, effectively, Aunt Karen expects a 12% per year return. You've just turned 20. So from 0 to 20, and this is annual, okay? She has deposited $100 for you every year. Okay? This is what has happened. Okay. And Karen expects a 12% rate of return. So the rate that you're dealing with is also 12%. How much is in your account right now? This is a very simple annuity problem. Can you give me how much is in your account right now? The right now that it's asking is when you are 20 years old. So when it is asking for, it's asking for price here, for amount here. What's the value that you find? It's an annuity, $100 payment, 20 years, 12%. That's correct, Nusha. What else? Anyone else? That's correct, Ragavi. So really, the amount is 7,205 is in my account right now. Now, the second part of the question is a little bit of tweak to this annuity. If Forgetful Aunt Karen forgot to deposit on your 5th birthday, so somewhere in between here, which is number 5, she forgets to deposit. So we have a hole here, right? How much is in the account at the age of 20? Now, instead of breaking this annuity into 2 parts, that's too messy, right? The only thing you have to do is that, okay, if she forgot $100 when you were 5, that means that $100 could grow to something now that you're 20, right? 15 years of growth is lost. Find that value, deduct it from 7,205. That's correct, Ragavi. But first tell me, $100 over 15 years, how much is it worth? Can you tell me? That $100, how much is it worth? Over 15 years, 12% per year. So find the future value of the present value of $100. Oh, sorry, are they every month? Very good. Diana just corrected me. So payments are $100 every month. My apologies. So 20 times 12, like that. And the 12% rates, you have to divide it by 12. Thank you, Diana. Good job. Yeah. That's correct, Nusha, if you done it correctly. So $100 over 15 years times 12 could have grown to 3,727. And we deducted. That's correct, Kevin. Good job for catching the error. And that's how you are going to forget it. You are going to solve it, actually. You have to convert to monthly. Don't forget, everything has to be monthly. You have to convert to monthly. So if you give me that answer, that's wrong. Is that right? So, Diana, did you get the answer? So when you do monthly, if you do the monthly, how much is the money? So this is wrong. I'm sorry, guys. That was the annual. So you have 20 times 12, which is how many periods? 240. So compound $100 over 240 months with the monthly rate of 1%. What's the answer if you do that? So basically for part A, you're asking me to explain one more time. For part A, you're going to plug in the payment as $100 negative so that you get a future value that's positive. You're going to plug in N as 240. You're going to plug in your I over Y. Don't forget, whatever that N is, your I over Y should be consistent with that as 1% because that's the monthly rate. And then there's no present value. You are going to solve for FV for me. Can you find that FV? How much is that future value? I believe the answer is 98,926. That's the most popular answer I'm getting. Daniel, can you find your error? Did you plug in these values that I gave you monthly, 240 40 periods? 1% is the monthly rate. Don't forget that. Carlo, can you check what your mistake is? Very very good. The rest of you gave me the right answer. Sophia, did you find your mistake? Yeah, very good. Carlo, 24 instead of 240. Sophia, that might be your mistake too. Okay, we're good now. 98,926. Now let's do the second part. Do the second part for me with the same logic. The $100 compounded for me, $100 compounded for me for 15 times 12. So this period here is 15 times 12. Very good. That's a good question. Jessica is asking, why are we finding future value if it asks how much is in the account right now? Because it says you have just turned 20. So right now is the future that Aunt Karen was thinking about. I told you guys, future value and present value, it's not about real time. It's about in the problem setup. Future value is the later time. Present value is the earlier time. I am now 20, right? I wish. That means that this is 20 years after Aunt Karen deposited. Got it? Very good. So Victoria gave me the answer. No one else gave me. So for part B, what would be the value of that $100? Because we have to deduct that. That $100 that she forgot, what's the value, future value of it? No, I think you guys are doing it wrong. It can't be 49,000. It's just $100. So it's not the payment anymore. It's not the payment anymore. It's the PV. She only forgot $100. She didn't forget the $100 for the rest of the years, okay? So what you're giving me doesn't make sense. Take that $100 as PV, as present value, compound it for 15 times 12. That's correct. Very good. Antonio, Hiba, Daniel, now you guys got it. Diana, that's correct. So really that $100, it could have grown to $599 here, right? It could have grown to $599. You lost that amount, okay? So you are going to deduct that. So take that, deduct that from the payment, and then you're finding the future value. That's correct, David. I'm going to post the answer so I don't spend more time on this, but you guys got the idea. The second question then, which is going to be question, 4. Okay, this is going to be our question 4 in this set of slides. It says you're planning to model the kitchen, excuse me, and we'll need to borrow $15,000 total cost, okay? So this question is you're going to need $15,000 for your renovation. So in this question, this is borrowing. So is it fair that I say that this is present value of the borrowing, like the mortgage size, like the principal borrowing? That's basically clear to you. You have two options of financing. You can borrow this amount, the $15,000. You can borrow it from a bank with the following terms. The bank says, give me 40 equal payments, due at the end of each month, so it's 40 monthly, with a coded interest rate of 18%. And we know that when we have coded interest rate, that means it's the annual rate, APR. And it's going to be compounded monthly, okay? So it's giving you some description of a loan. The second one says, okay, you can borrow the money. How much? Again, your present, the amount that you're borrowing is not changed. I'm going to borrow 15,000. But the two offers that the bank is giving me are different in the rate and in the payments, okay? So the second one says you can borrow the money from a trust company with quarterly payments. So this time it's not monthly, it's quarterly, of $1,100 payable at the end of each quarter for 5 years, okay? So 1,100 payable at the end of each quarter. Now, here are the two scenarios that we have. You calculate the monthly payments required by the bank in part 1. So part 1 has given you the rate, but didn't give you the payments. So in part 1, it's an annuity. Find the payment for me. In part 2, it gives you the payment. So 1,100 is the payment, but it hasn't given you the rate. So find the rate for me, I over Y. And then once you did that for part 1 and part 2, the question says which loan is better. Now here's my question to you. When you want to compare the two loans, what do you need to compare them? Let's see if you remember from last week, the banks question that we had. When we wanted to compare the offers from the three banks, what did we calculate? No, Joy, think about it. Very good. Jessica, that's correct. No, Nusha, think about it. You want to not this question. We're talking about, okay, the part B. You want to compare the loans. Whenever you want to compare loans or compare two products, no, Victoria, think about it. We had it last week. We had Bank A, Bank B, Bank C. They each had different offers. That's correct, Claire. Very good. So I've got the right answer from Claire, Rebecca, Maria, and also way in advance, Jessica gave me the right answer. Very good. That's correct. Joy, Alyssa, that's correct. So whenever you are going to compare, you're going to compare their EARs. Okay? EAR is the answer. So that's my guidelines, guided steps for this question. I just tell you what you need to do. Now you have to do it yourself, because if I just show you, then it loses its purpose. You're going to do it yourself. I'm going to post the answer. You can check the answer for yourself, okay? So you need effective annual rate. So this question has two parts. The first part, calculate everything about option 1, everything about option 2. Option 1, you have to calculate payment. Option 2, you have to calculate I over Y. For part B, you want to compare the rates. And now that you want to compare the rates, calculate the EAR, or effective annual rate. Is that good? Okay. Now the last question, is it? Yeah, 5. So question 5, for the set of questions that we have here, is your 40-year aunt wants to start saving for her retirement. So this question is a retirement question. She expects to retire at 65, and she thinks that she will have saved $500,000 by the time she retires. So her retirement goal is $500,000. She also expects to live to 90. Okay, none of us know how long we live, but for some reasons, like, we have to assume we know when she dies. Okay, so we're going to assume she dies at 90. So this is a retirement problem. And for retirement problem, what I can tell you is that you should always draw a timeline. Otherwise, you won't get the right answer. So this is your time 0, which is your 40-year-old aunt. Okay, she's 40 now. She's going to live until she's 90. And retirement is at 65. Okay? So parts A, B, and C are all about her lifetime, like that you see in this timeline. Anything that, and this at 65, we call it retirement, and the retirement goal here is $500,000, right? 500K is the $500,000 here, is my retirement goal. Think about it. That $500,000 is a lump sum at 65. Everything before $500,000, that means everything when I am for retirement, is called the saving period. When you are in the saving period or saving zone, your contributions, again, is an annuity that you're making towards what? Something that becomes a future value. So that $500,000 is future value for your monthly, yearly contributions, whatever that is. After I retire, I get into a period that we call it spending period, right? This is my spending period. When I'm in the spending period, again, it's an annuity. It's a different one. And that $500,000 becomes what? This time it's a present value. Does that make sense? So it's the same $500,000 we're talking about, which is here. For the second part of the problem, anything about spending, consider it a present value of annuity. Anything about saving, consider it a future value of an annuity. That's all I can tell you about this problem. Sit down, draw it for yourself, and try to solve it so that when I post the solutions, it makes sense to you, okay? We're going to go over the solutions again next class, which is in 2 weeks, so that I prepare you for your midterm class. The midterm, that's going to be a review class, so I'm going to go over all of this again. At this point, I trust that all of you are going to go and solve these 5 problems, solve end of chapter problems, and also hopefully do well in your quiz 2. Any questions before I finish the class? And I'll let you go get ready, get a quick review for your quiz 2, sorry. Also, you saw that I have posted the solution to quiz 1. I will do the same for quiz 2, but not after the break, okay? I can do it in the 2 weeks. Okay, there is no makeup midterm. I'm getting some questions about makeup midterm. There is no makeup midterm in this course. Please look at the course outline. You can see the details. There is no makeup midterm in this course. You can either take the midterm, or if you have a valid medical reason, then the grade, the point is going to be, the weight is going to be transferred to your final. Kevin, I'll post the answers and I'll go over the solutions in class again. So Maria is asking what is in the midterm. Maria, chapter 1 to 5. So can I trust that you're going to look at your textbook and take a look? Because some of the stuff that I taught you today is part of chapter 5. So chapters 1 to 5 is part of midterm. Everything I taught you today is part of midterm, okay? Everything I taught, yes, correct. Amanda, good catch. So chapters 1 to 5 and chapter 18. Yes, Lukshina, good job, yeah. Guys, again, it's on the course outline, so best is to check that, okay? Hawa, again, it's posted on the D2L. Quiz 2 begins at 5:30, yes. Jillian, that's a good question. The question is if we have the office hour next Monday. It's Thanksgiving Monday, so we don't have any office hours. And it's also the reading week, so no office hours. I'm going to see you the Monday after for the office hour. And I'm going to have one more additional office hour closer to the midterm. I'm going to post that. Correct. In terms of what's on your midterm, Jillian, Nusha, you guys are asking about the midterm. David, please see the course outline, guys. It's already in the course outline, the format and everything. In terms of coverage, again, everything that we've been taught, slides, textbook, sample midterm, sample final, those are the stuff that you can look at. Mirel, you can always go and do your MyLab Finance for practice. This is something that's available to all of you. You cannot use it to be graded, but your labs are always available to you for practice. No problem, Jillian. Yeah. Anything else, guys? I think we're in good shape, and you have a good half hour to practice for your quiz 2. I hope that you all do well in it. Again, 4 problems, guys. Everything is randomized. Focus on your own. I'm sure you guys are in good shape by now, but if for any reason you have temptation to ask a friend, don't do that, because it's going to be a different problem, different, very similar wording, but a different tweak in it. So you won't understand and you just get a wrong answer, okay? So focus on your own work. Make sure you know how to use your calculator for the quiz, and you will be in good shape. Yes, Jordan, I will just post the answers. That's right. Okay, guys, have a good break. I think I answered everything. D2L, Mina. I announced so many times already. So your question is answered on D2L. Grant, your question is answered on D2L. So I won't take up the more of time. I already shared that on D2L and in the class multiple times. Any questions, guys? Okay. Good job. Have a good reading week. Enjoy your Thanksgiving, guys. Please do well in the quiz and better in the midterm and make me proud. Bye. Thanks, guys. Bye.
वैसे मेरे कपड़े से कहीं बैठे नहीं है तो साफ हो गया।
एग्जैक्टली। अभी मैं तेल लगा लूँ फिर टोपी पहन लूँ या अभी तेल आके लगाऊँ?
नहीं तेल लगा लो।
टोपी गंदी हो जाएगी मेरी और डिस्गस्टिंग लगेगा तो बाद में लगाऊंगा। छोड़ो फोन एक्चुअली जेब में रख लेता हूँ मैं अपने को, अभी 1 घंटे बाद फिर निकलना है।
यार तुम से रखो, मुझे अपना
ना
बंद हो गया क्या? मम्मी पकड़ो।
क्या हुआ? हाथ धो लो अपने। क्या हुआ?
ये रिकॉर्डिंग नहीं हो रहा।
लैपटॉप बंद कैसे हो गया? हाँ चार्जिंग नहीं थी?